So let me introduce our moderator, Andy Hoyne from an unbelievable law firm, Polsinelli. Ryan Rakestraw from Monsanto Growth Ventures, and also was extremely helpful in making this happen. So afterwards, let's make sure we give a warm welcome. Next, down at the far end, we have Michelle Myers with Cultivation Capital. And then we have Dennis Milton from the SBA. Rumor has it that they do loan money. And Lex, a guy who I worked with last year. Unfortunately, it was a deal we couldn't get done. We were trying to buy some food technology from Homeland Security and a university. But unfortunately, it didn't work. Bob Calacatera has forgotten more about deals than most of us will ever know put together. So welcome to our panel. Give them a warm welcome, and then Andy's going to kick it off.
Well, thank you. Welcome, everybody. We're excited to be here. Our topic is funding, M&A, and exits, and we could probably spend 2 weeks or at least a couple days on this, so we're not going to cover all of those topics. We're primarily going to cover funding, because you can't get to an exit or an M&A unless you get some funding along the way. I am going to point out just one tidbit of information with regard to mergers and acquisitions. New over the last year or two or three, as opposed to years ago, a lot more regulatory considerations for disruptive businesses. So think Uber, and whether you can get a taxi cab license, that sort of stuff. Any kind of disruptive business, that's something you need to factor in on. And the biggest issue in almost every business now is data security and privacy. So we're going to talk about money. A couple of tidbits of information on this. Money is hard to find. I'm not saying anything, but if someone says, "Hey, I think I can get a lot for you," just be careful about that. Virtually all decisions which you make as a company putting together are going to you have to look at the filter. How will this affect how I raise money? How will this affect how I raise money? So look at the name you have, state of incorporation, corporate entity that's formed. How will it affect raising money? And remember, when you're raising money, that you're raising money as an investment opportunity, not as a science project. And so that's sometimes founders of companies, especially the scientific people, get confused and they start talking about how great the science is, all this, that, and the other. It's important, of course, but you really want to talk about an investment opportunity. Here's how I approach stuff, and then we're going to go over the panel and you can kind of look at this. I basically ask myself 6 questions. Number 1 is, what's the problem? What's the problem this investment opportunity is trying to solve? Is it a big problem, little problem, important problem, whatever? What's the problem? What's the solution that the investment opportunity is trying to address? Is that solution just another Me Too, or is it really something that's very incremental, adds a lot of value to the whole process? Third is, what's the timeline to go from having a problem to the solution is in effect? And then the next point to think about is, what's the team that's being assembled or going to be assembled to implement that timeline to get to the solution? And then at the end of the day, how will the investors get out? And then, as Tom talked about, is the investment opportunity attractive? But if you look, so we had just one more example. We had a phone call today with some company. We're struggling to raise money. They're a very good company. They got a lot going. But we start pushing the CEO as to what's going on. Well, she said, yeah, some of the investors are saying our team is too lean. So we've saved a lot of money by not having a big team, but the investors are saying it's going to be a big round. We're going to do a lot. We need a much bigger team than this. So it's a team issue. Also, some of the investors are saying, gee, if you could do what you're planning to do in 4 years, in 3 years, then maybe that would be more attractive. So it's a timeline, not what's involved, how long it's going to take, how realistic is it to implement that stuff. And the other question is, what's the problem? How big the problem is? And so we've got 2 technologies in this company. One that's we're kind of developed along the way, and the other one is more early stage. But the investors potential investors are saying, gee, I kind of like the more early stage one. Maybe the problem we're working on is the wrong one. So those are the 6 things I look at when I'm talking to a client trying to advise them. So now we're going to go down the panel here. And Ryan's up next. We'll start at this end. He's going to give you his tidbits of information.
Sure thing. Thanks a lot, Andy. So I'm Ryan Rakestraw with Monsanto Growth Ventures. We're the corporate venture capital arm of Monsanto. I'm going to let Michelle give a lot of the venture capital piece, but I thought that I would talk a little bit about corporate venture capital, knowing some of the other corporate venture capital firms in the St. Louis area and kind of how we're unique with respect to a private venture capital firm. Also thought that I would talk about a great source of funding, which I like to call customer funding, also known as revenue. And we'll talk about some of those relationships where we've worked to give early stage companies some revenue and how that's worked out well for them. But maybe just as a little bit of an intro, our team has really been around 4 or 5 years now. We do venture capital style investments in companies that have technologies or business models that we think can influence the future of agriculture. Got a little bit of a glimpse of that from Rob's talk earlier today. But since inception, we've invested in about 13 companies. For the most part, invest in the U.S., although we invest outside of the U.S. And generally, we're investing $2 to $5 million as part of a $5 to $15 million round. So I think that's meant to say that we're generally investing alongside other investors, whether that's strategic or financial investors. We look to be active in the companies that we invest in, and that's in the sense that we're looking to both add value as we would from a typical venture capital list, whether that's helping to recruit the team, helping with governance, helping with industry connections and relationships. But then we do really look to find some other collaboration or co-development type opportunity between the companies we invest in and the broader Monsanto enterprise. Very exciting time in agriculture. I think Rob kind of hit on that. We've seen a tremendous amount of opportunities, and a lot of the opportunities has kind of been at the convergence of information technology and the life sciences, being able to use bioinformatics, being able to use technologies like machine learning developed more in the advertising technology space to help sort through some of this data that we're generating now. So that's probably our piece. Push it over to Bob, and he'll really tell you something.
So those of you that don't know me, when I left the Nida Center, I actually got involved with a fellow by the name of Randy Weiss, and we added a third partner in what was at that time called Startup Midwest, which gravitated to Startup Partners International. We actually, in a period of from 2008, when I retired from Monsanto, to 2013, started 11 companies with the 3 of us. And we actually were acting CEOs of those companies to get them started before we turned it over to somebody that was more qualified than we were to run the companies. Good news is the 4 I was involved in have raised now about $170 million. Bad news is none have exited yet, but the other good news is 2 of them are very close to exit. And so pretty exciting. But the disadvantage of what we were doing is we only had enough people to basically become interim CEOs. So we've created a new model, and that's Exeter, the Exeter Group. We actually have about 12 partners as part of the Exeter Group, many of them people who have been CEOs of companies, as well as we cover all the capabilities, marketing. And you'll hear from John Harden in one of the other panels later, who is a marketing person. We have financial people. We've built a whole structure of the company that covers all the disciplines. So what happens is we can put into the companies that we create a whole management team. For example, there's a company, there's a technology from the University of Arkansas, Little Rock, that I'm going to be the CEO on. We will, in fact, be the CEO, the president, the chief financial officer, the marketing, the vice president of marketing, as well as cover the engineering side of that company. as well as a business development person. So we're able to put a top-notch team into the company day one. The interesting thing about Exeter is we are starting 3 companies. None of them are from St. Louis. They're from elsewhere. In fact, one is a combination of technology from Israel as well as Purdue. One of them involves 4 universities in the United States. And the one from Arkansas also involves the University of Tennessee. The 4th one that we're looking at, and we've got a verbal commitment, is some students from WashU. I guess I would say that when we look at companies, we basically look at 3 things. Really, is there a value proposition that makes sense? Is the technology unique? Is it a situation where there's no freedom? There is complete freedom to operate, and is the IP good enough to be able to protect this company? Then what we do is when we start this, in many cases, we've got to clean the situation up. Many times people have tried to start the company and they've failed because they really didn't understand how to commercialize technology. Secondly, we've got to get it structured properly before we go out and try to raise money. I guess my position is you really can't plan M&A and exits because things change over a period of time. You can certainly look at who are the potential people you're going to sell the company to. And you can look at comparables and say, well, it possibly could get to a point where you sell it for this amount. But that's about all you can do. So that's what I do.
Very good.
Hi, I'm Dennis Melton. I'm the District Director for the U.S. Small Business Administration. We do loans through lenders and bank and non-bank lenders to small businesses. We have a mission since 1953 to help small businesses start, grow, and compete in a free market system. So that's pretty much what we do. And we do it through the 3 C's. We call the first C is capital, access to capital, which is probably the primary function. Nothing gets started without money. The second one is counseling. We do free and confidential counseling through resource partners to whom we give a grant. And the third is access to government contracts, and we have some set-aside programs for special groups of people to get access to those contracts on a non-competitive basis. Getting back to capital, though, that's the primary reason for this panel, is I want you to know that we don't make direct loans. We partner with these banks, and we do it through a loan guarantee program. So if a bank will make a loan that they probably would pass on otherwise, we will guarantee a portion. One fellow said to me, so you're our cosigner. Well, that's kind of what we are. We tell the bank we'll guarantee a portion of the unpaid balance of that loan, anywhere from 50% to 90%, depending upon the program. 90% would be for an export loan. 50% is what we call an express. That's where a bank uses their own paper and process. And then there are several in between. Our flagship programs, one is a 7A, that's primarily working capital. The second one is a 504 loan. That's for fixed assets, primarily real estate or depreciable equipment. So the beauty of those programs is that just about anybody who has a good credit score and a solid business plan can probably get access to that money. There's no equity exchange. It's strictly a loan. It's a debt. But that's the beauty of it too, is when you've exhausted your family and friends, or yourself, this is a place to turn to. This is a way to leverage the money from the bank in exchange for continuing your business forward. We get involved often at growth times. That's the best time for us. Nothing eats money like growth. And that's when a lot of businesses come looking to the SBA for assistance. So that's pretty much what we do from a loan perspective. We're not a venture capital a group. We are a strictly debt relationship with our borrowers, and where primarily our relationship is with the bank and non-bank lenders. Your relationship would be with the bank. Michelle?
All right. So my name is Michelle Myers. I work for an early stage venture capital firm downtown out of T-Rex called Cultivation Capital. So we were launched in 2012, and since our beginning, we've really been focused on creating early stage funding opportunities for startups located in the Midwest. So we have a few funds that we operate, and we invest in technology, specifically software companies, as well as life sciences companies. So to date, we've deployed about $32 million across 37 different startup companies. So we typically invest at the point after startups have exhausted some of the earlier stage sources of capital. So they've typically raised money from angels, they've exhausted founders' capital, friends and family, and they're at the point where they are looking to really grow and scale their operations. So that's typically when we come in. And I hope this is okay as far as agenda, but I know Andy had asked me to speak just kind of generally on raising VC. So I thought kind of an interesting focus might be on how to know when VC financing is a good option for your business and when it might not be. I actually have a quick question. So how many of you, in the audience that have a company have raised VC financing? So it's interesting because a really small percentage of companies, I think it's less than about 1% of all of the companies in the US go on to raise venture capital financing. So it's a really small percentage, and I kind of just wanted to focus on how to know when VC financing is right for you, because it's not right for a majority of businesses. So it's kind of just interesting to keep in mind. So a good analogy that we use, and I didn't make this up, is that raising VC money is a lot like adding rocket fuel to a business. So VCs have really set expectations as far as how a company will perform after they invest. So I think the example is VCs want to get your business into orbit. So they want you to scale and expand quickly and reach really high levels of revenue. So when deciding if VC is right for your company, you really have to ask yourself whether your sales and your market are large enough to meet the expectations of what a VC is looking for. VCs look for companies that can reach sales between $50 to $100 million in revenue, and often in a short period of time. So anywhere from maybe like 3 to 7 years, just depending on the firm. So not only are VCs looking to reach that high level of revenue, but in a short period of time. So VCs want big outcomes. They're looking for home run investments so that that's above normal returns on their investment. Usually about 10 times the capital that they've invested. So that usually that return comes from the acquisition of a startup by another company is typically what happens. So it's just, I think the takeaway is to keep in mind, to really evaluate what sources of capital are available to your business. I think there are plenty of sources available, whether that's founder money, credit cards, high net worth individuals, other groups that would be perfectly happy maybe doubling or tripling the return on their investment. It might make more sense for a company or might be more applicable than generating the types of returns that a venture capital firm is looking for. Just to keep that in mind, you can generate great returns for yourself, your employees, and may have perfectly happy customers just maybe through other sources. But if venture capital is a good option for you, I did want to leave you with a couple tips. So I'm pursuing a relationship with a venture capitalist. I think an interesting analogy is that getting to know a VC is a lot like dating. We don't want to get married after a weekend in Vegas. So I think we want to get to know you. We want to know the founders, watch them execute, and really see a team that's making good progress before committing to invest. So fortunately, we have a really great tight-knit startup community here in St. Louis. So, with events like these, it's really easy to get to know people, who represent all the different sources of capital, like the people, here on this panel through events like this. So it's easy to get to know, a lot of the local venture capitalists and develop that relationship early on. So especially for firms like ours that take a really active role in the companies that we invest in, we want to be a partner and help companies build their business. So it's just important to kind of build that level of trust, over time, and be able to communicate the different metrics that are important to your business and show that whether it be user numbers, revenue, channel partners, whatever that important metric is for your business, that you can, grow and show, the potential VC that you can really kind of get the ball rolling. So I just wanted to give a couple of tips there.
Great. I'm going to have some questions for the panel, but here's some, maybe go back and just kind of run through just so we're all talking on the same page. So when you start a business, you have the initial way that someone can get funding, money for that business, is from your own bank account, your own credit cards, your own mom and dad, brother and sister, whatever you have in your own self kind of pocket that you can go. That's pretty simple. All you need to do is just decide, talk to yourself, do I want to put in $10,000 into this company or not? And then you can go and do it. Now, if you're married or have a significant other, you may want to chat with the significant other to see, should we put $10,000 in this company, or $5,000 or $1,000 or $2,000. But if you're, that's the first place you go to and think about how much of your own money do you want to put at risk. The next level up, and then kind of recognizing that there's, as Ryan talked about, there's revenues, and revenues are always good because revenues can, you know, it's, as long as you're making money when you're selling things, those are non-dilutive capital. They don't take equity. You don't have to get that money from somebody else except for customers. You're selling a product. Revenues are one thing. A second thing on the other side are things like grants, SBIR grants, STTR grants for companies in the science sector are great. They just take a long time to get through. But so we had a company that we worked with, and I think that company along the way is actually sold to Monsanto at one point. I think that company raised $15 million of equity over 10 years, but it also had $15 million of grants and corporate money and that sort of thing. So it had a half and half, and we don't see enough of those companies, but those are good things to do. But on the equity piece, in the middle, you have your own private checkbook, whatever you can afford to spend, and I'll tell you, most entrepreneurs don't spend a lot of money. The next thing up is someone mentioned friends and family. Friends and family or friends and family and fools. Those are folks who invest on the basis of you as an entrepreneur. They may have no idea about what your technology is all about or anything. I trust you. So if Ryan said, hey, Andy, I'm putting together a company to do biometric design of corn or something, yeah, something like that. I say I have no idea what that means, but I can put some money into that because I trust them. Well, we haven't talked about it, but anyway, so that's friends and family. That's kind of the next level up. We start going into angel networks. Angels are wealthy individuals. It's a kind of the buzzword for accredited investors, people with certain income or net worth things. And there are networks about that, and I'll ask Bob about the accredited investor network, the angel network. And then we go up to the venture capital firms. The venture capital firms, as Michelle talks about, cultivation capital, early stage venture capital firms. Early stage, we mean by kind of early in the process. They go along bigger. The funds get bigger and bigger and bigger along the way. We have the buzzwords which we use in venture capital investing that's called a Series A, Series B, Series D. The first round of money coming in after the friends and family is usually called Series A, Series B, Series C. Why do we do that? Why not Series 1, 2, 3, and 4? Or like the Super Bowl, 1, 2, and 3, and so on, because that's the way people do it. So here's some questions for you guys, and then I have some more after this. Ryan, so people say, gee, I've got a great opportunity, but it would really help if I could tie into some corporate investors. It's one thing where you can bump into you here, but let's say I'm in a totally different industry and the best people are somewhere else. How do I do that? How do I make those connections?
Yeah, I think like any other sales process, I mean, getting some type of referral into the organization is probably the best way to get introduced and to learn about some of the needs. From the pure funding standpoint, we've got an email address that's on the Monsanto website, but that's kind of a cold introduction. So finding somebody, whether that's LinkedIn or some other network that has access into the company that can provide a warm introduction is probably the best route. Our team tries to make ourselves really available. We attend a lot of conferences. We try to be out in the community. We try to be active with other venture capital investors and accelerator programs and community groups to learn more about the innovation and the startup companies that are there. From just the selling your product or service to Monsanto, I think that for those people who are taking notes, there's a great book that talks about selling to businesses called Crossing the Chasm. It's a classic book by Jeffrey Moore. And that really kind of talks about the approach of identifying needs within a business or within our organization. And I'll tell you from the Monsanto perspective, and we've done this a handful of times with a number of really early companies where we've been their first customer or their second customer. It's really about kind of identifying the problem, like what was discussed before. And every, whether it's Boeing or Purina or Emerson or Monsanto, every enterprise has kind of got it may be the same type of problem, but they've got their own, unique aspects to it. And what we really like is for startup companies, for entrepreneurs, to really meet our needs in terms of the problem that we have, that there's some type of solution that's really well tailored for our particular problem. Now, as you're scaling that business, you need to say, well, my technology or my product needs to work for Purina and it needs to work for Monsanto. But us being the first customer, we want to really know that we're getting some special attention from you and you're really thinking about our product. So I think about a company that's not a St. Louis company, unfortunately, but a company called Nirvana Systems that has a really slick software for analyzing data. And we were one of their first customers. We learned about this company through a venture capital relationship that we had, and we just brought them into St. Louis and talked about our problem. And they were able to kind of develop a software-oriented solution that helped us analyze some really unique data sets that we had. And that's been repeated over. A company that we actually ended up investing in, but first we were a customer, was a company called HydroBio that's based in Denver. And this company uses satellite imagery to help farmers know how much water to use in their field to help with irrigation decisions. And it ends up being that Monsanto is not a farmer in a commercial sense, but we actually sell seed, and we've got to grow all those plants to make our seeds. And a lot of that is irrigated. So this company, in approaching us, they were willing to kind of tailor their product to meet our particular needs and use case, and it ended up being a really nice revenue stream and customer relationship that worked out well for them. So I would say, on the access, find someone that can get you a referral. Me being here in St. Louis, I'm happy to be that person that can help you navigate Monsanto and get to the right place and right person. Or if worse comes to worse, just reach out. But until you reach out, that relationship doesn't exist.
So the interesting thing is, I may be wrong on these numbers, and you have to kind of factor that in, that every situation is different. But as big companies have cut back to a certain level the amount of the R&D that they're doing, they have to reach out to smaller entrepreneurs who can come in and fill that R&D pipeline. Some industries more than others and that sort of thing. But in many cases, so one of the statistics I read somewhere was that the amount of corporate venture capital investment was it approaching the same as amount of sort of venture funds? It's a significant piece.
It's about a quarter.
It's a quarter,
Yep.
Whatever. So it's significant piece and a significant part of the thing. You mentioned, Ryan, who are the other firms in town that have?
Emerson has a venture capital group. Enterprise, it would be surprising. Like Enterprise has a corporate venture capital group. I mean, you kind of name it. It's a lot of
Express Scripts.
And that's the acceleration of technology. Technology used to come from the DoD or NASA. More and more technology comes from venture-backed companies like Google and Tesla and that type of thing.
Yeah. So I mentioned angels before, wealthy individuals who want to invest in startup companies. Then, so the definitions are someone who has $200,000 of income or $300,000 of income with their spouse, or a net worth excluding their house of $1 million. You put a bunch of these people together and you get what's called an angel network. And there are at least two in St. Louis that are pretty good size, kind of open public about this stuff. One's the Billiken Angel Network, and the other is the St. Louis Archangels. And Bob Calcaterra is the founder of the St. Louis Archangels, was its president for a dozen years, 100 years, something like that. But Bob, why don't you talk a little about how the Archangels process works, how you get in the queue,
Sure.
what it takes to be selected, how do you guys decide who you're going to invest in?
Sure. What I might say is it was founded in 2005. It actually took a year for us to get it started. And we did have our angel network here before we started the Archangels, which was a disaster. And so we were very careful in the way we started it. It now has about 85 members. We've made about 60 million in investment since 2005 in about 50, it's 50 plus deals. In fact, I'm an investor in 23 companies. So I'm pretty tapped out. I've had one exit. The interesting thing is the way we do it. We have 10 meetings a year, and we skip July because of obvious reasons, it's vacation time, and we skip December because of obviously Christmas. But the way you apply, you actually apply online to stlouisarchangels.com. And it's a very simple document to fill out. Probably takes 45 minutes. But of course, you have to be very careful how you answer all the questions. And then there's a group of us, and it varies every month. There's kind of an intermediate step. There is a group of us that look at the applications, and then we invite a certain percentage of those applications to present to another group, actually physically, right towards the second week of that month. And there's typically 8 or 10 people that show up at this meeting, and we hear the presentation. And then after you've left, we cogitate about what we've heard, and we decide, we don't like, it's not very efficient to have 5 companies present to a group of angels, because they're like everybody else. They lose interest and get bored after seeing a huge number of deals. So we try to hold it to, at best, 2 to 3 deals a month that we look at. And so we have, that early group has to make that decision. But then on the last Wednesday of the month, we actually have a members meeting. And as you heard me say, there's 85 members. Typically, we'll get anywhere from 40 to 50 people that show up at those meetings. And it's a network. So you present, and then we actually have a sheet that's passed around to the membership. And the membership say, I'm highly interested, I have some interest, I'm not interested at all, and forget it. Then what happens is the administrator, if in fact there's a high percentage of interest among the angels, will try to find one of the members to lead a group and get everybody together so that they can meet with the company for a longer period of time. Presentations are only 10 minutes with 5 minutes of questions. And so you don't really get to present much. The whole purpose is to get interest from the angels. And so then we might have an hour and a half meeting with the really serious people to look at the opportunity and then go forward from there. I've seen deals done in a month. I've seen deals that have taken 6 months or 8 months because the group has felt they needed to see the company progress a little further before they actually invest.
And they're investing $200,000 to $1 million.
Yeah, that's interesting. We've had investments from $180,000 total to investments in a couple of actually companies that I was involved in. We're well over $2 million, but it's been in 2 or 3 investments. Okay. But typically, the first investment, if people are really interested, can be as much as $400,000 or $500,000. We actually one deal that the first investment was close to $1 million. So it's all over the ballpark. But as I said, we've gotten up to, I know in one deal we got over $4 million from the group. In a couple that I've been involved in were $1.5 million, another one $2.1 million.
Very good. Hey, Dennis, on the SBA programs, tell us a little bit about kind of what terms, how much money would someone get, and are there personal guarantees?
Sure.
What are sort of the way that the system
Yeah,
works?
our program, we have 2 flagship programs, if you will. One is 7A, as I mentioned, the working capital. The other one is fixed asset. Our loans can go up as high as $5 million for the 7A working capital program, up to $5.5 million if it's the fixed asset, if it's involved in manufacturing or energy. The terms are usually about 10 years unless real estate is involved, and it can go up to 25 years if it's real estate in the 7A, 20 years if it's the 504. The 7A loan is your typical fully amortized loan. It's a term loan. It can be fixed or variable rate. The 504 loan is the, as I mentioned, the fixed asset, and that's done through a certified development company, certified by the SBA. I think we had St. Louis Economic Development Partnership here earlier. They have a certified development company and part of their group. And it's usually an economic development group that's in your area that can do these SBA loans. And what it is we float debentures. It's tied to the Treasury note. With that, you can get 40% of your loan covered by the SBA as a loan, usually below market rate. You have to bring 10% if it's a standardized building. If it's a specialized building, such as a gas station or dry cleaners, you might have to bring 20% because it'd be more difficult to liquidate. And then a bank of your choice or the certified development choice, either one, will do 50% of that loan, and that can be fixed or variable. But what they like, why a bank will make this loan is because with a 50% exposure, they get the first lien. The SBA certified development company will take the junior lien. So for 10%, you can get into a building, which is pretty low. The terms are much better than what you're generally going to find in commercial. And that's what makes it nice. If you get back to the 7A loan, the working capital, if I can draw a picture for you, a mental picture. When you go into a bank or a non-bank lender and you fill out your loan application, they're going to put it in one of three stacks: yes, no, and maybe. Yes is the loan they're going to make without the SBA. They're just going to make that loan because the credit is perfect, the business, it's everything that meets their model. The no loan, they're not going to make that even with an SBA guarantee. That maybe stack is our stack. That's where we can see how far into that stack we will go in terms of making the guarantee, helping that business get that loan. And that's what the whole idea is. Banks are sometimes hesitant. You know, by nature, entrepreneurs are risk takers. By nature, bankers are risk averse. So we try to bridge that, and that's what we do with our loan guarantee. So if you go into a bank, you're going to want to be prepared. You know, you're going to want to be able to go into that bank and tell them exactly how much money you need and how you plan to disperse it. You do not want to ask them how much they will lend you. They want to know that you're in charge. You know exactly what you're going to do with that money before you get it. You're going to want to bring along 3 years of tax returns. And remember, if I can just kind of give you the bullet at the top, what you're trying to do is convince them you can pay them back. That's what they're interested in. They don't want to own your assets. That's the last thing they want is a default. So you're in there to show them, here's how I'm going to pay you back. We are not a collateral lender. We are a cash flow lender. So cash is king to the SBA lender. And that's what you're going to want to show them is that you can cover your, you can service that debt with the proceeds from your business. So yeah, there's a lot of things that you want to be prepared for. I guess the bottom line is that we have longer terms. We usually have better rates. And we do have a cap on what the rate is. The rate you're going to get is depending upon your credit score, kind of credit that you've developed. But we'll generally tell them it's prime plus, and you can come in underneath that plus. So once again, protect your credit score like it's gold, because it is. And when you go into that banker, you've got some benefits to your side. We will guarantee it so that they'll pick up what they would normally leave on that table.
Thanks. Hey, so Michelle, I'm going to put you on the spot with two questions.
Mm-hmm.
Number one is, what percentage of the companies that talk to you guys do you actually end up investing in? And the second question is, when we haven't gotten into it, but could you explain to everybody what due diligence is? Dennis kind of mentioned bring some tax returns and that sort of thing, but what's due diligence? How do you guys look at that? What should people be thinking about to be prepared for due diligence type questions?
Yeah, absolutely. So I don't know if I have an exact percentage as far as the number of companies we invest in, but we take a look at hundreds of companies a year. So I mean, that's usually a mix. A lot of the companies we look at come from referrals. So oftentimes from other venture capital firms. Maybe they, have come across a really good opportunity. It's just not quite at the right stage for them to invest. So they think of cultivation capital might be a better fit for the company. So a mix of referrals from people that we know, people in the community, as well as some cold outreach as well. So we do, look at as many companies as possible. I think we did diligence, which I'll explain, on about 200 some companies last year. So we do look at quite a few companies. So I think, in total over a year, we have 3 different funds right now. The ones we're actively investing from usually make between 5 to 10 investments per year. So ultimately, there'll be between 15 to 20 companies in that portfolio. So it turns out to be a very small percentage of the companies that we ultimately look at that get funding. But at least for us at Cultivation Capital, we do keep up with the companies, or we at least tell the companies that we speak with and evaluate to keep up with us. So even if a company isn't quite at the stage where they're ready for an investment, a venture capital investment from Cultivation Capital, we want to keep track of their progress. So like I was kind of talking about earlier, building that relationship and being able to show your numbers increasing and growing over time, and being able to build that momentum is really important to us. So we do just kind of surveys and things that we keep up with the different companies that we evaluate, because we want to know how they're doing over time. So as far as what the diligence process, so after we have an initial phone call or initial meeting, with a startup company, we, if it looks like something that may be a fit for our firm, so meets our, investment criteria, we'll start a process called due diligence, and this is really where we're getting an in-depth look at the company. So we have a whole request list that we'll typically send out. So this is where we're looking for financial projections. We'll actually do some interviews with customers and just a whole, checklist of items that we'll need to see from the company, and we really take a look at all of that to try to get a better understanding of what type of return investing in this company could generate for our company, and then ultimately the limited partners in our firm. So I mean, it's a process that can take, I'd say a month to a couple months, sometimes longer, just depending. But we do have a whole team that will take a look at all of these materials that we get from the company. And ultimately, who makes the investment decisions in our firm is our investment committee. So we do have an active group of people who typically have industry expertise in the companies that we're looking at, who sit around a table and ultimately make this decision on what kind of return this can generate for us and whether it matches our investment thesis and would be a good investment for our firm.
Great. I think I'd be not doing my job as a lawyer to just point out that actually the fundraising aspect is covered by federal and state securities laws. When you start looking at the investments, if you printed out the pages, you'd get thick pages of agreements and so on. So it's certainly the kind of thing that one would typically use a lawyer for. As a practical matter, there's a lot of us in town who do that sort of thing. A lot of those terms are negotiable. There are certain things that different investors say, well, I got to have it this way or I'm not going to invest. But there are others where there's a little bit of give and take, and you can kind of work that way. Let me mention a couple other things. One is that there's all the accelerators in town. I think all the accelerators have something called demo days, where they have companies coming and talking about what their companies are. So that's a way to go and say, hey, I want to go and see what companies are doing, how they're making their pitches. Those really aren't investment pitches per se, but those demonstrate what the company's all about. And it would be good experience at some point, if you are in the business, if you're planning to raise money, is to see some of those programs and then say to yourself, gee, would I invest in this? It seems like a great opportunity, or it seems like these guys don't have any idea what they're doing. Those are demo days. They happen during the year. Secondly, there's a group called Invest Midwest, which is a venture capital conference, which is held every year in April. This year was in St. Louis, next year's Kansas City, back in St. Louis, back and forth every year. And that has a program that's geared to 30 companies, give or take, who come and do presentations, 10 minutes.
45.
45 companies in life sciences, tech, or everything else. and you can see them, good presentations, and a good opportunity to see how people are pitching to raise money, and you can compare your story to them. So we're going to take some questions from the audience now.
Hey, Bob, hold on. Let's see if we have someone else. You always get that. Anyone else have a question? Young lady over here.
What percentage of the VC investments are IT?
Of IT. VC investments total, or?
Give us an idea. It seems to me it's a very large percentage.
I think it's close to like 75%.
That sounds about right.
Yep.
Yeah, 75% or so.
Ag is like 1%. Although it's been growing quite a bit. And in fact, it used to be about a $500 million a year business, has grown to about a $4 billion a year business.
Now there's ag tech, right?
Yep.
Yeah, so that's
Hold on, Soren. By the way, this is where our next session is going to be. And so we're going to be able to have a few extra questions. So I'm getting kind of giddy. All right, Teresa.
Yes, so Bob, you mentioned that for your personal investments as well as the Archangels investments, you haven't seen a lot of exits. And I know that St. Louis is anxiously looking for some, but my knowledge isn't great beyond St. Louis, so would you tell me that based upon where Archangels Group is today, is that typical or atypical?
No, it's typical. As you know, exits take a long time, especially in the life sciences. It's not unusual, especially if you're in the drug area, to not see an exit for 12 years. And on the ones that I've been involved in, we're in about the 7th or 8th year. And I'm seeing the possibility of an exit within the next year or so. But those are not drug deals where you don't have to go through the first FDA approval. With IT, it can be faster. But it's interesting, some statistics I've seen recently is even though the venture investing in the plant life sciences is less, the record is actually better than IT. The failure of IT companies, because candidly there's a lot of competition out there, has not been quite as good, but it can be a lot faster. We've had some exits in the IT area here in St. Louis that have come within the first 3 or 4 years.
It just dawned on me, we were talking about exits a lot, but just so that's when your investors get their money back. That can be an initial public offering, that can be an acquisition, that can be some other type of payment where people who have invested you and you get their money back and preferably some multiple of that money that they've given you.
And it really is acquisition, not public offering. Although the public offering market is looking better now.
All right, Bob, not wait. I got Soren is going to ask and by the way, please give him a round of applause. He was instrumental in putting this together.
I don't know the statistics.
For each of our groups or in general?
So the national statistics, and they kind of vary, but the way I look at it is somewhere in the low $20 billion a year, $20 to $25 billion a year national venture capital statistics. Of that number, about a third is in Silicon Valley, and a sixth is in Boston. And then you have a bunch of other cities, Seattle, San Diego, RTP, maybe New York, a couple others that have other big chunks of that other half, and then you have everybody else. And we're in the everybody else. We're doing better, but we're still in the every place else. So if the number was right, if it's 75% is in IT, then you're looking at whatever that is, $17.5 billion, give or take, a year in IT and all kinds of computer infrastructure and all those kinds of investments. So somewhere
There's an issue, Soren, related to what Andy said. We have a problem in St. Louis, and it's not just St. Louis. It's all the companies that we're bringing in are from areas that are low investment areas, is that we don't have the large funds that are able to invest in the C and D rounds when you're talking $5, $10, $15 million. So what, candidly, companies that I've started, one's in Philadelphia, one's in Minneapolis. That's not because of venture, it's because it's the right place for it to be. But it's because the large venture companies have come in and put $30 million in the company and said, "What, we're going to have a new CEO, and that CEO wants to stay in Philadelphia, or he wants to be in San Diego. Therefore, the company's going to have to move." So that's a problem we have, as well as not enough seasoned CEOs that people will invest and leave the company here.
I mean, I don't know if I would necessarily say that it's a problem in a strict sense. I mean, I think we rely on the entrepreneurial community in St. Louis to be a little bit more capital efficient, to maybe creatively figure out ways, whether that's business development, licensing, lower burn rates, to not have to raise $30 million. Now, maybe that caps the upside potential. Maybe it's hard to create a $1 billion company, without having to raise $50 million somewhere around the route. But can you build a really nice, successful company that employs tons of people, here in St. Louis without raising that sum of capital? I think that could absolutely be true.
And I would agree to that.
And I would say
If you
that's an
could-
absolute success, though.
Yeah.
Yep. Well, if you could exit after 10 million, that's a hell of a lot better than exiting after 250 million.
That's
Yeah,
right.
I'm leaning towards San Diego versus Philadelphia, Bob. All right, Bob, last question. And then we're going to take a brief break. We'll need you back in here, in 10, 15 minutes tops.
Probably best directed to either Michelle or Bob or both, but I've heard that angel investors were sometimes referred to as the farm team of VCs. How many VC deals come after an angel round, or do VCs jump right in at a first round or an A round?
Do you want to answer that, Michelle, or do you want me to?
Okay, go ahead.
Actually, Cultivation Capital has been a wonderful partner with the Archangels. They've invested in a number of our deals that have gone through the Archangels. I would say that, it fits somewhat with what Ryan has said, is if in fact it's a deal where you have to raise significantly more amounts of money, then yes, we do become a farm team of venture funds that put a larger amount in. It's always wonderful to have a local venture fund put money in because they're much more friendly than the East Coast venture or the West Coast venture people that come in. And so as an angel investor, it's a rough business because when the guys from the coast come in, they tend to make the deal tough on the early investors. So the lower the amount, the better the arrangement with, the better the deal for the angels, where you might get an earlier exit instead of a later exit after, you heard me say $250 million. You got to sell a company for $1.5 billion to make anything. If you can raise 10 million and exit, then you can make a lot of money if you exit for 100 million.
The prospect of venture capital coming in at the start, I think,
great.
works only in theory, or if you're a serial entrepreneur that's done 2 or 3 companies, taken them public, and made a lot of money, and those investors want to come in, or you're a Nobel laureate who's done 2 or 3 companies and done things there. But for by and large, the investors, it's so rare to hear the investor say, gee, I wish I would have gotten in earlier. It's usually, gee, this is too early for me. I want to wait till more of the risks are come out. So the one venture guy told me, he said, you know, investing early is what we call adventure capital. He's venture capital. Later on, all the risks are removed, as many as possible, maybe just as commercialization, whatever. They don't want to be involved at the early stage, again, unless there's really a proven track record or there's something really unique and special.
All right.